Okay, guys, in Chapter 2, we are going to be talking about using T accounts. T accounts are just a tool to help you separate your transactions into debit and credit parts because we will be learning how to journalize these into a general journal soon. So it can help you figure out which parts need to be in the debit and which part needs to be in the credit. So for most businesses, the accounting equation can get absolutely huge with hundreds of different accounts. The accounts can go into the millions of dollars and stuff. And this is where T accounts can come in. So a T account is a device used to analyze transactions and can be used for each account in the accounting equation. In a T account, the value of all things owned, your assets, tend to be on the left side, and then the value of all your equities or claims against assets, liabilities, and owners' equities are on the right side. So we are going to, if you look at this T account here, so see if you have the assets left side, liabilities, owners' equity, right side. So we're going to create T accounts for all the different types of accounts that we have talked about so far, and we are going to classify their debit and credit side, and we're going to classify which side is the normal balance for each type of account. So again, your accounting equation has to be balanced. And a good thing to remember too when you are using T accounts is that debits always have to equal credits. So debits must equal credits. An account is a record summarizing all the information pertaining to a single item in the accounting equation. So we've gone over a few different accounts. We've got our cash account, our supplies account, and we've gone over some, we have our Johnson Capital account, our accounts payable, Supply Depot, and so on. So there are special names for amounts recorded on the left and right side of a T account. The amount recorded on the left side of a T account is always a debit, and the amount recorded on the right side of a T account is always a credit. That never changes. So the left side, again, debit, right side is credit. The side of the account that is increased is always the normal balance side. So the normal balance side is the increase side, and then whatever is not the normal balance side is the side that would decrease. So as we go through this, any asset is going to have a normal balance on the debit side. Any liability is going to have a normal balance on the credit side. And any owner's equity capital account is going to have a normal balance on the credit side. But we're going to break them down here separately so you can see. So a few accounting rules that we have here. Account balances increase on the normal balance side of an account, and account balances decrease on the side opposite to the normal balance side of an account. So here's how we would set up a T account. So we are setting up a T account here for our cash account, okay? So we draw the T, which is how it got its name, and we're going to label the top part of it for cash. Okay, so again, the left side is the debit side, the right side is the credit side, and that's the same for every account. So left side debit, right side credit. For cash, because cash is an asset, the debit side is the normal balance side. Okay, all assets have a normal balance on the debit side. So cash has a normal balance on the debit side, which means that the debit side is the increase side and the credit side is the decrease side. Here is a T account for accounts payable Miller Supplies. So accounts payable Miller Supplies, all accounts payable accounts are liability accounts. So again, left side is the debit side, the right side is the credit side. That doesn't change for any of them. But accounts payable is a liability, meaning the normal balance for a liability account is going to be on the credit side. So the credit side is the side that increases, and the debit side is the side that would decrease for an accounts payable or any liability account. So here is a capital account. So we have Jeff Dixon Capital. Again, debit side is the left side, credit side is the right side. That does not change. For a capital account, the normal balance is on the credit side. So the credit side is the side that has the increasing side, and the debit side is the decreasing side. Okay, so you need your work together paper now, and it should look like this. And we are going to classify these accounts. We need to label on every T account, we need to label the debit side, the credit side. We have to label the normal balance side, and then we also have to label which side increases and which side decreases. So we're going to start here with cash. Cash is an asset, okay? So first the first thing we want to do is label the debit side and the credit side. So if you remember, the debit side is the left side. So this would be the debit side, and the right side would be the credit side. Cash is an asset, so it's going to have a normal balance on the debit side. And the normal balance side is the side that increases. So the debit side is going to be the increasing side for cash, and the credit side is going to be the decreasing side for cash. Okay, move over to accounts payable, supply mania. Okay, first we'll label the debit and credit side. So the left side is the debit, the right side is the credit. Accounts payable is a liability. Liabilities have a normal balance on the credit side. The normal balance side is the side that is the increasing side. So in this case, for a liability, the increasing side is going to be on the credit, and the decreasing side is going to be on the debit. Next one is accounts receivable, Butter Inc. Okay, so first we're going to label the debit and credit side. So the left is the debit, the right is the credit. Accounts receivable is classified as an asset. Assets have a normal balance on the debit side. The normal balance side is the increasing side. So for accounts receivable, Butter Inc., we are going to be increasing on the debit and decreasing on the credit. Okay, let's go over to Johnson Capital. So Johnson Capital, the left side is the debit side, the right side is the credit side. Oops, I spelled that wrong. A capital account has a normal balance on the credit side. The normal balance side is the side that increases. So for Johnson Capital, the credit side will be the increasing side, and the debit side will be the decreasing side. Prepaid insurance. So the left side will be our debit, the right side will be our credit. Prepaid insurance is classified as an asset. Assets have a normal balance on the debit side. The increasing side is always the normal balance side. So for prepaid insurance, the debit side is going to be the increasing side, and the credit side will be the decreasing side. Okay, the next one is accounts payable, Smith Office Supply. Okay, so the left side is the debit, the right side is the credit. Accounts payable is a liability. Liabilities have a normal balance on the credit side. Normal balance side is the increasing side. So for accounts payable, Smith Office Supply, the credit side will be our increasing, and the debit side will be our decreasing. Okay, the next account is supplies. Okay, so our supplies T account, we will label the left side as a debit and the right side as a credit. Supplies is considered an asset. Assets have a normal balance on the debit side. The normal balance side is the increasing side. So for supplies, our increasing side would be the debit, and our decreasing side would be the credit. Okay, accounts receivable, Teen Titan Corporation. So the left side is our debit side, the right side is our credit side. Accounts receivable accounts, so accounts receivable Teen Titan is considered a asset. So we are going to have the normal balance on the debit side, and the debit side will also be our increasing side, and the credit side will be our decreasing side. Okay, then Butler Capital account is going to be left side debit, right side credit. Capital has a